Hello, savvy investors. It's the Dividend Uncle, and today we're embarking on an exciting journey into the heart of Singapore REITs. Buckle up as we unravel the intriguing narrative of their performance, a story that unfolds from the remarkable surge since October 2023 to the recent sideways dance in the early days of 2024. But here's the twist: amidst the stabilizing prices, is there an opportunity hidden in plain sight? The Rollercoaster Surge. Let's kick off with a thrilling ride through the rollercoaster surge in Singapore REIT since October 2023. Picture this: the CSOP iEdge S-REITs Leaders ETF catapulted a staggering 16%, marking a noteworthy turnaround. But rewind a bit, and you'll discover a tale of struggle. Prior to this surge, the ETF experienced a disheartening 15% decline since January 2023, and almost a heart-stopping 30% slump since the peaks of 2022. The culprit? The ominous rise in global interest rates. The consequences of this interest rate hike were felt deeply. As interest rates climbed, sentiments toward investments sensitive to these changes, especially REITs, took a hit. Being highly leveraged, REITs felt the pressure, causing a domino effect on their prices. Many investors, witnessing a prolonged period of decline, started losing confidence. The dividend yields of numerous REITs, including blue-chip ones, shot up, some even surpassing the 6% or 7% mark. But then, a twist in the plot emerged around Q3 2023. With inflation rates easing globally, the Federal Reserve dropped a bombshell, a good one at that. It hinted at the possibility of decreasing interest rates in 2024. This announcement acted as a spark in the powder keg, reigniting interest in rate-sensitive investments. However, as the financial markets are renowned for their capricious nature, things took an unexpected turn. Since the dawn of the new year, the CSOP iEdge S-REITs Leaders ETF experienced a minor setback, sliding down approximately 2%. So, as we look at the REITs market now, it seems a bit confused, with prices moving sideways. What does this mean? Is it like the calm before a storm of recovery, or is there a more nuanced narrative at play? The Dividend Uncle's Take. Now, this is where it gets exciting. With whispers of interest rates going down in 2024, I see this as our golden ticket. The sideways dance might be an invitation to look closer, find opportunities in the quiet. But the strategy here should be more nuanced than what we did last year. Given that the REITs ETF has surged 16% since the bottom, and many blue-chip REITs have gone up more than 20%, we have to be perceptive and selective in where to put our money. To conduct a thoughtful evaluation, I've scrutinized the ranking of REITs based on their performance since October 2023. I've categorized them into three groups: underperformers, boasting returns 10% and below during this exuberant period; overperformers, showcasing returns exceeding 30%, and those dwelling in the middle ground. The idea is straightforward. Delving into the realm of underperformers, are we likely to uncover hidden gems, or are there valid reasons for their lackluster share prices, signaling a need for caution? Simultaneously, as we explore the top performers, have they potentially become overvalued, or is there more to come from these stocks? This is the ordered list of REITs with their performances from highest to the lowest. Feel free to pause the video to examine the full list, but let's proceed to the underperformers. The underperformers. Stepping into the realm of underperformers, those REITs that have yielded returns of 10% and below during this dynamic period, I propose categorizing them into two distinct groups. The first category features REITs that, quite ironically, maintained stability throughout the year, avoiding significant declines before October 2023. Consequently, their performance post-October was more subdued. This group includes Fraser's Hospitality Trust, Parkway Life REIT, and to a lesser extent, Paragon REIT. The second category encompasses REITs grappling with idiosyncratic issues of their own. Here we find Sabana Industrial REIT, entangled in the internalization of its manager led by activist investor Kavarts Capital, Lipo Mall Indonesia REIT contending with persistent weak financials, and Keppel DC REIT facing potential tenant solvency risks. Now, let's unravel the intricacies surrounding these underperformers, deciphering whether they represent an overlooked opportunity or a well-founded cautionary tale. While the first category of REITs demonstrated stability, in a year poised for the recovery of REIT prices, I'm hesitant to allocate too much of my funds to them, as more rewarding opportunities might lie elsewhere. Within the second category, Keppel DC REIT stands out as having the most promising potential for a turnaround. In a previous video, I underscored tenant risk as the most significant concern for Keppel DC REIT. On December 15, 2023, Keppel DC REIT announced it had demanded late rentals of about 9 million Singapore dollars from the tenant, Guangdong Blue Sea Data Development, a subsidiary of Neo Telemedia. You can find the link in the top right-hand corner. In the same video, I emphasized that the management has a solid plan in place should things take a turn. Keppel DC REIT possesses the capabilities to take over the master leases from Neo Telemedia and manage the data centers on its own. The top performers. Now, turning our attention to the high performers, those REITs flaunting returns surpassing 30%, the question looms large: is their current lofty status sustainable, or are they teetering on the edge of overvaluation? Upon closer examination of the top 10 performers, a striking observation emerges: 9 of them are purely overseas REITs. Before hastily diving into the overseas REIT frenzy, let's navigate these findings with more nuance. I propose we categorize these 10 REITs into 2 groups. The first category comprises long-suffering REITs from the US, UK, and Indonesia, including Prime US REIT, Keppel Pacific Oak, Manulife US REIT, Elite Commercial REIT, First REIT, and potentially United Hampshire US REIT. While the latter doesn't grapple with fundamental structural issues like the tumult in the US office space market, there are common risk drivers. Despite their impressive returns since October 2023, most of them haven't bounced back to their prices at the year's outset. I'm not entirely convinced they've weathered their worst times. The second category features a select few overseas REITs with robust fundamentals, justifying their price surges. This elite group includes Daiwa House Logistics Trust, Digital Core REIT, and REUS Hospitality Trust. In my prior videos, linked in the description, I've expressed optimism about these REITs, citing the strengths of their respective sectors, their adept capital management, and solid financial metrics. Therefore, my perspective is that while these REITs have rebounded robustly, we should keep a keen eye on them, as their stars are poised to continue shining brightly in 2024. Conclusion. And there you have it, folks, insights from both the bottom and top performing REITs in the past 3 months, hinting at potential opportunities in Keppel DC REIT, Daiwa House Logistics Trust, Digital Core REIT, and REUS Hospitality Trust. I'm calling on all investors to assess the opportunity presented by the current breather in the market and sideways trading. If you enjoyed the video and are eager to stay updated on dividend shares and REITs, don't forget to subscribe to my channel and follow me on Instagram. See you soon.